Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Herman Chan has a CFA. He's also been monitoring the bank earnings. And JPMorgan got us started today, although the stock, as John mentioned, is off by 2.5%. And banks are the worst performing group in the S&P 500. So, Herman, a big takeaway for JPMorgan's latest results.
Yeah, takeaways is that the performance was strong. So we're talking about really strong markets, trading revenue year over year. Investment banking was a little light. And then the balance sheet lending growth was really good. So solid quarter all around. Guidance was in line with what they had expected heading into the quarter, but a couple lingering things, higher expenses for 2026 as they continue to invest for growth. We're talking about $9 billion increase in expenses, and then the credit card cap is still lingering across JPMorgan and the large banks.
Herman, since everyone's been talking about the proposed cap by President Trump on credit card fees, what was the messaging from JPMorgan on the impact of that?
The messaging was that this would have drastic repercussions, not only for JPMorgan, the banking industry, consumers, and overall GDP growth. So you think of credit as being the lubricator for economic activity. And when you slash card rates, that really will reduce the credit availability for a lot of JPMorgan's customers. So you can think of a large swath of them just not having credit card usage going forward under a 10% rate cap.
And JPMorgan is obviously a lot more sensitive to a potential cap on credit card interest rates than some of the other big banks. I mean, this is a bank that just purchased the Apple credit card business, is taking on that Apple credit card business that Goldman Sachs gave up.
That's right. So that's adding about 20 billion in balances, give or take. So that's something that will be helpful for them. But really, JPMorgan's one of the more active credit card issuers in our large cap bank coverage. Citi is the first, followed by JPMorgan, and then Bank of America, Citi, and U.S. Bank lag after that.
What's the thing, Herman, that stood out most to you today from JPMorgan's results? Was there anything significant compared to prior quarters?
Yeah, really the takeaways were just how forceful they were on the credit card rate cap issue. Just reminding everybody that this is not just a JPMorgan and banks issue. This is going to have really big repercussions for economic activity in the United States, and really will hurt some of the less advantaged consumers that I think really this rate cap would intend to help. And then the second one is really just they double down on the expense outlook, which surprised some folks when they unveiled that late last year. So $9 billion in higher expenses, really driven by growth, inflation, healthcare costs, et cetera.
I want to go back to the president's effort to cap credit card interest rates, because from what I understand, it's not something that he has the authority to do. This is something that Congress has to pass. Yet he's talking about this January 20th deadline. How does that work? I mean, he's calling for it, but calling for it doesn't mean that he can do it. Right.
So a lot of it seems to be posturing at this point, pushing himself to address some of the broader affordability issues heading into midterm elections is how I view it.
So why don't the banks point that out, or not point that part out, but call them out on the fact that this would take an act of Congress to do anything about it?
Right. Well, they're not. There was a question posed during the earnings call if somebody from the administration had reached out to JPMorgan, and they said that, as far as they know, nobody has. So a lot of it seems to be just tweeting by edict at this point. So we'll see if that shakes out to be something else more definitive. But we would expect the banks to push back and really wait for any congressional legislation to come in to really cap the rates.
Herman, this slowdown in investment banking revenue, down 5% from a year earlier, do you expect that to pick up later this year given the expectation for more deal making?
Yeah, that's right. The fourth quarter seems to be more of a blip to us. Fourth quarter investment banking usually is seasonally soft given the holiday season. Sounds like from their comments that a few deals were pushed out into the first quarter. So these deals didn't go away. They were just delayed. And looking ahead into 2026, we see robust activity in investment banking. You can just think about the IPO calendar that's really firming up. And then for M&A activity, we think lower rates will help. This deregulation effort by the administration is helping increase consolidation, not only in banks, but in other industries as well. And then we've seen sponsor activity, private equity players really jump back in. So those are really strong factors for improving investment banking activity next year.
So, Herman, how does this set us up for the other big bank earnings, which will be reporting over the next day or two? How is this changing expectations for, say, Citi, Bank of America, Goldman Sachs, Morgan Stanley?
That's right. So JPMorgan really set a high bar for markets in trading. So up about 17% year over year. That's going to be tough for others to meet, but that's where the bogey is at this point. And in terms of investment banking, we probably expect some others to do a bit better than the year-over-year decline for JPMorgan. So more to come on that front.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's shift gears and talk about big tech, because the news this week is that Apple is partnering up with Google, Alphabet, the parent company, to power the iPhone's AI technology using Gemini. Gemini, of course, has become kind of the software that everyone's looking at right now as a big winner in the whole AI battle. So let's bring in Anurag Rana, our Bloomberg Intelligence technology analyst, on this. And Anurag, people are already crowning Google as a winner here in the AI battleground. And it definitely looks like Gemini is picking up momentum, picking up market share. What specific advantages does Google bring with Gemini to Apple?
So, we'll give, first of all, credit to Mark Gurman from breaking this back in November when he said, Google will work closely with Apple on this model. Now, when we go back in history, Apple doesn't have that big of their own foundational model on which it's running or it's supposed to run some of these technologies. But Apple and Google go back a long way. They have a very, very good agreement on search, which pays Apple billions of dollars. So, there was some legal issue around it. So we always knew that once that legal issue goes away, Apple may be working closely with Google to basically outsource a lot of their foundational models into the technology that they have. Now, it's possible that the next Siri upgrade, which is most likely going to be in the March-April timeframe, could be that one big moment that we are all looking for Apple to finally come out and say that, okay, we are not a laggard in AI, that they also have a product that's pretty good.
Anurag, I saw a tweet actually from the official Google account announcing this deal, and Elon Musk replied. He said that this seems like an unreasonable concentration of power for Google. Obviously, he has a vested interest here given, his participation in XAI, but does he have a point? What are the regulatory risks around this deal?
Yeah, he won't have a point if his model was being used at that point. So, everybody's trying to pitch Apple to use that model. But, at the end of the day, Apple actually, for the first time, if you go back a year and a half ago, they used OpenAI. You can still use OpenAI when you go to Siri and ask a question, and it can take you out of there. But for Apple, it has to be integrated within the iOS, within the software, but they won't do it to an outside vendor where they don't control the data. So what Apple's going to do here, they're going to use the foundational models from Google, but they're going to run a lot of that either on the device or their own private cloud data centers, which means they will still protect the privacy of that question and not let it have access to other players as well.
Yeah, the privacy angle is really big for Apple. It's kind of its mark of distinction here among the big tech players. Anurag, Apple has seen this exodus of talent, AI talent, going to other big tech companies in recent months. Does this multi-year deal with Alphabet, with Google, change any of that? Does that stanch the bleeding at all?
Yeah, for me, it does, only because I am now buying the model outright from somebody who's doing all the hard work. So I'm not in the business of model development. If I can use the best model that's out there into my product and I pay them some money, and the rumored amount is about $1 billion a year, which is, to be honest, nothing compared to how many billions these companies are spending to come up with their own large language model. And that's what actually Apple said in the search case, and says, I'm not in the search business. If Google has the best search, I will outsource that technology into my products from them.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Scarlet Fu and Alex Semenova in for Paul Sweeney. I'm kind of tired of shopping. I've done so much of it in the past month or so.
I get so overwhelmed.
I don't believe that for a second.
What do you
by
mean?
The way.
I'm not into it.
It's very overwhelming to walk into a store these days.
Yeah.
Trying
Price
to
points are
find
way too
something.
high. And then also I'm just tired of it because I did so much of it in the last couple of weeks. But maybe technology will help me. Maybe it'll make it easier. It'll take some of the friction out. We want to bring in Travis Hess. He is CEO of Commerce, which is traded on the NASDAQ under the ticker CMRC. Travis, you're going to tell us how AI is changing shopping. But in particular, this has to do with what Google has been doing with this thing called the Universal Commerce Protocol. Explain how that will make my shopping needs easier.
Well, given the extent to which Google plays in all of our lives and how people think of them, it's essentially setting the foundation and the standard for brands and retailers and other organizations to be able to scale agentic commerce across all of the surfaces that Google AI would hit. So think of the contextualized conversations everyone's having through answer engines today. Those conversations are then dynamically recommending not only experiences and facts, but certainly shopping and brands based on the enrichment of data against those surfaces. And Google is enabling a standard by which consumers would be able to buy in a standardized, safe, secure way. As it serves up discovery, you'll be able to buy seamlessly across those surfaces.
Travis, can you walk us through how AI will change the shopping experience in practical terms? Let's say I'm looking for a bag. How do I go about using your platform?
The consumer behavior has changed more than anything. So the amount of eyeballs and behavior going to the answer engines is probably the fastest adopting technology we've seen. So because the consumers are going there and they're having these conversations, brands and retailers are having to respond in kind, and they tend to have a fair amount of brand ethos. So they're very concerned about where they show up, how they show up, and who they show up next to. So trust is at the cornerstone of this. So a lot of the foundational stuff you're hearing about now is to set up that trust. So when you're shopping for that bag, it's giving you a response that you can objectively trust. It's not serving up who paid the most to be listed or injected in that conversation. The thesis behind this is based on your own behavior within those answer engines. And of course, other behavior within Google, whether that's through Chrome or through other Google products, they have a unique advantage there because of the amount of surfaces an individual might use to synthesize that in a hyper-personalized way. So think of it as, I don't like shopping either, but think of it going into your favorite store and someone, as you walk in, can scan a code and immediately knows what you own, what you like, where you're going, what you're looking for, so they could curate something for you immediately, where that friction is removed through the process. Think of that virtually in this particular capacity. That's the future state.
So all the information that Google has on me, they are also selling. Who are they selling it to?
Oh, that's not for me. That's not for me to opine on.
No. So I mean, the reason I ask is because it depends on me logging in to Google for them to give me those personalized recommendations. If I don't choose to log in, then I end up with the equivalent of a Google search on a public computer.
You do. I think the models are changing. Certainly, the old model was you're searching for terms, and certainly organizations are optimizing through SEO to be listed organically at the top, or they're through paid search being listed. That still exists today, certainly, and there's behavior that drives that. But where this is evolving to is called GEO, so generative optimization, which is really going to be a combination of structured data, which is like product catalog data, SKU, color, size, all those dynamics dimensions, coupled with unstructured data, which are brand guidelines, call center transcripts, blogs, articles, all the things that would contextualize that brand and that product, if you will, that's being enriched, oftentimes by us on the Feedonomics side, which is part of our portfolio, and then syndicated across these different surfaces, be that Google or OpenAI or Microsoft or whomever. And it's going to continue to expand as the channels have expanded over the last several years.
Travis, we have the National Retail Federation Conference underway. I believe today is the last day. What kind of AI trends and retail trends have you been monitoring out of it?
It's all about AI this year. That's what's hot. Exactly this, right? I think there's two sides of the spectrum. There's a lot of buzz, which is exciting, but at the same time, it's confusing a lot of people because everyone is doing everything. And it's hard to kind of reconcile like what's meaningful to the business. I think for larger organizations that we work with, brand manufacturers and retailers, trust, brand ethos, and security are top of mind. So for them, it's less about the sizzle, it's more about the steak and the foundational elements. I think the importance of the Google announcement is they are taking a very pragmatic approach to this to lay the tracks. So this can scale and scale properly with trust, with security, and most importantly, with a frictionless experience for customers, because the brands don't want to lose that customer data. They still want to maintain that experience, even though they're not fully controlling the surface by which they're showing up against. It's not like they're showing up against their own website. So they're in a surface they don't completely control. They're controlling part of it through the data enrichment and syndication, but they're not controlling all of it. So they're very, very concerned that that experience is a positive one and a frictionless one. Otherwise, it has ramifications. It drives cost up in call centers. It drives maybe a negative customer experience. It drives bad
returns.
Exactly, returns, bad things on the back end. So that's the reconciliation people are trying to have. But yes, the AI has sucked all the oxygen out of the room at Javits, and it's a big room.
What will AI not change for shoppers?
What will it not change for shoppers? I think the behavior and the surfaces by which they're still going to go to, right? I think new ones are showing up. I think the expectation, personalization's been promised for a long time.
Yep.
I think there's some hesitancy there around the trust. So I think overcoming the trust aspect of this and having that reinforced through continued behavior. The shopping's very new. There was a big rush to do this in holiday, and the experiences weren't great. So I think there's a little bit of hesitation. I think you'll see a much more robust offering this holiday season.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Delta is the first airline to report earnings as well. And according to the stock market reaction, investors not too impressed. The shares of Delta are down about 2.8% after its full year forecast came a little bit lighter than anticipated. Let's bring in George Ferguson right now. He is our senior aerospace defense and airlines analyst, joining us from Princeton, New Jersey. George, at the start of 2025, Delta sounded very optimistic about demand, about what pricing looked like, and the forecast that he gave today kind of stands in contrast to that.
Yeah, I mean, Ed Bastian, I think, was a little reticent to get too deep into what he sees happening in 2026. He said, there'll be surprises, much like they received in 2025. And I just think as people look at the results, really what we saw here from Delta was a continuation of the premium and the loyalty revenue are rolling in strongly, I think, sort of 5 to 7%, if I recall correctly, above sort of GDP growth rates. But the back of the airplane, they call it the main cabin or basic economy. That revenue was down 7% in a quarter where Delta was growing a couple percent. And so, I think we still see this premium trend, and I think we're going to see a lot of growth in premium seats this year. We've got Southwest converting to to more of a full service carrier with premium. Delta plans to go premium. United plans to go premium. Alaska, JetBlue, everyone wants to go premium. So I think there's probably some concern in the marketplace that maybe premium gets crowded and pushes closer to that main cabin kind of fare rather than main cabin coming up.
Maybe too much supply. We'll see. By the way, Bastian, the CEO of Delta Airlines, will be joining Bloomberg Television Surveillance on Wednesday. That is tomorrow, of course, at 8:15 a.m. Eastern Time for a live interview from Delta's headquarters in Atlanta.
And something that stood out to me, Scarlet, was that Delta said they're bracing for risk to their forecast, noting the geopolitical environment, whether it's international or domestic policy. George, is this unusual for them to issue this kind of warning?
Again, I think we're at the beginning of the year, and management teams like to caveat things, right? And so I guess what I would say is we had plenty of geopolitical challenges in 2025. We were watching transatlantic demand closely because you've got a war raging in Ukraine. It's been doing that for a bunch of years now. Didn't seem to slow down that demand. That demand seemed to do okay. Some days I wonder if there's more risk domestically, right? One of the other things we're watching is the president wants to cap interest rates for the credit card companies at 10%. Loyalty through the Amex program brings a lot of money in for Delta. Definitely a source of their competitive advantage. And I think if you're capping interest rates, I think some of those credit card programs have to change, and that would hurt some of those loyalty programs. So there's risk all over the place all the time. But again, the geopolitical didn't seem to hurt demand as much as we would expect it in 2025.
Right. It kind of always threatens to hurt demand, but in the end, people still prioritize traveling and paying for traveling. George, I'm looking at some headlines coming out on Delta at the start of this hour, and one of the comments from Delta was that the airline industry could see consolidation in 2026. Which players would that most likely involve?
Yeah, so we're already starting to see some of that, right? We had an announcement the other day that Allegiant and Sun Country are going to put themselves together. They're two smaller, low-cost airlines. Some of them pretty quickly growing. So they'll consolidate. We've heard discussion about Frontier potentially buying Spirit Airlines. We still have to see, the ultimate outcome for Spirit. They're in Chapter 11. We're trying to figure out what the restructuring looks like the second time they've been there. So you can see on the edges, especially where in that low-cost marketplace, you can see consolidation beginning. It takes a long time, and that's the challenge. But you could see some of that consolidation already begin. We don't see the big players getting consolidated. Right? You're not going to put together. I think you're not going to see sort of a United, a Delta, an American, a Southwest. We're not going to put any of those together. I think that's too much. But I think a lot of other stuff is potentially in play.
George, we also got news that Delta is ordering 30 Boeing 787 Dreamliner jets, aiming to boost the company. How much do you expect this purchase to impact its bottom line?
Yeah, so they're not going to see these airplanes until 2030. So it's a bit of a ways away. They're replacing 767s, which are old airplanes. We have an average age of them about 27 years right now. The 787 is going to be a lot more efficient. Delta gave some numbers, I think 15-ish plus % more efficient. So I think that really helps the bottom line. Also very interesting to us is that Delta is traditionally more of an Airbus shop. They buy a lot of Airbus product. The recent wide bodies they've bought are Airbus's A350 and Airbus's A330. Again, the Boeing wide bodies, I just told you, 28-ish years old. Interesting to see them come in for the 787. That's really, I think, been a category leader in that small narrow body world. Boeing has over 1,000 orders for that airplane. We see rates continue to rise, which will improve profitability at Boeing as they put more throughput in that 787. I thought it was a bit of an endorsement for 787, even though Delta's not going to say that probably.
Yeah, George, you mentioned that Delta is traditionally an Airbus carrier. Do you think we'll see more of that, these airlines kind of splitting the difference between Boeing and Airbus?
I think every airline has to be a little bit that way in order to keep the manufacturers competitive, right? If the manufacturer knows you just got to come in for their product all the time, I do think that hurts you. But a lot of times that we see a lot of airlines have a preponderance of a certain type of product.
Right.
It keeps costs down, right? Because you train your pilots for one type of wide body, one type of narrow body, and it helps you keep your costs down. So and your maintenance push is easier.
Yeah.
Spare parts needs are lighter.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.